Thank you, Mark, and good morning, everybody. And I truly am quite honoured and delighted to be able to address you this morning. The last time I had that honour and pleasure was a week after my very good friend Ralph Tully actually took his new position in Lloyd's. And it actually happened to be at the time when another very good friend of mine actually took the lead of the international group P&I clubs away from its historic leader, Jensen Green. And it was a very interesting period of time. So when I'm going to try and reflect on the marketplace and the challenges that we face, and really try to sketch what I feel the greatest challenges for our future. And I live in a global marketplace. I absolutely believe with Steve's description of the London marketplace in the fact that it has remained at the very centre of our global industry. But there are a number of us that have been outside of London that have tried to build markets that have similar characteristics to London, but obviously not on the same scale as you've been able to achieve here, as well as just the sheer diversification of the marketplace that still exists here. I want to go back to a couple of things that Mark said in his introduction about ROEs. And yes, I'm sure that there are some interesting ROEs being produced at the moment. But if you actually strip away fee income and get to real underwriting profitability, the underlying core business is rather fragile at the moment, and I expect it to remain fragile for some time to come. And I'll try and tease that out as we go through my presentation. I'm not going to bang on this morning about regulation. I think our industry globally is being overwhelmed by it. I see very little value to either our shareholders or our customers, or quite frankly to for the regulators, apart from actually keeping their numbers ever multiplying. I think the delay of Solvency II is a welcome delay from an industry point of view. I actually support many of the measures of Solvency II because I think it brings much greater and better corporate governance to a much more unified standard across the industry. Although when I reflect back on a similar initiative, but a different one, which was post-Enron with Sarbanes-Oxley. And if you remember, the thrust of Sarbanes-Oxley was to require that boards of directors played a much more active role in determining the risks and threats to the companies that they actually represented. And it is quite staggering to me that if you look at the financial crisis and the severity of the financial crisis that we've gone through and are still within, and you'll hear that from Roger after my speech, that not one person in the US has been sued under Sarbanes-Oxley. And I then reflect back on not only the sheer amount of extra work and the burden of cost from actually all of our businesses, especially those with close US ties, in actually implementing Sarbanes-Oxley. And the very fact that when push comes to shove, actually the regulators and governments failed miserably to enforce the principles that lay behind it. But as I said, I don't really want to spend a great deal of time on regulation. I've always believed in strong, transparent regulation. Our industry needs it. We are a global industry. Our host regulators have to be of a standard that are acceptable globally. But that is fundamentally different from what's taking place at the moment, which is an absolute duplication wherever we trade on a global basis. and the time and effort and cost that our industry is bearing as carriers is in great danger of overwhelming not only the management of our industry, but also the underwriting that's taking place in our industry. And for those of you that are underwriters in the audience, the amount of time that is now being spent on compliance issues that underwriters are having to take is almost equaling the amount of time that you're actually dealing with your clients and actually carrying out the business that you're employed to do. I see no value or little value in that at all. And one of the great problems we face as an industry is the fact we don't have a BAL-type industry association that can stand up and speak for us globally and speak collectively to the governments and the global regulators that we're facing. And it is something that our industry needs to address because we are far too fragmented on a global basis. We don't have a global industry association. And so we're in grave danger of continuing to be picked off by governments and their regulators and actually overwhelming our businesses to such an extent that we will just not have the flexibility and capability to trade as we need to in a highly competitive global marketplace. So I promised I won't bang on about global regulation or the cost of it, but I feel very, very strongly about it. And as somebody who's now unemployed and unaligned, I actually fear that the next 2 or 3 years will just be a matter of increasing regulation as opposed to the stripping down of regulation and actually really trying to understand what the regulation is there for. The second point that I'm not going to talk about is the surplus capital that seems to be pouring into our industry. And I touched on that when I said to Mark about the fact that if you strip away the fee income that carriers are now being seduced into taking, and you get down to the underlying capital, and then an industry that seems to be rather proud of itself of earning somewhere currently between, unless you happen to be lucky enough to be leveraged, as Lloyd's businesses are, but the rest of the world feeling very proud and trying to convince themselves that running a risk business with an ROE of between 7 and 11% is an appropriate return to shareholders. On a risk-adjusted, taking into account a risk-free rate, of course you can convince yourself. But on a risk-adjusted basis, absolutely not. So, and I believe that there's a grave danger within the industry that the seduction of hot money, because there's so much liquidity in the system at the moment, will deflect and weaken the underwriting standards that the global markets have. Without a shadow of a doubt, that these short-term capital entrants change underwriting practice because they are buckets that need to be filled, and those buckets in being filled mean that underwriting businesses, without a shadow of a doubt, have to compromise their underwriting philosophy. I know that within the industry we say otherwise, but what's happening now is that in traditional cycles, underwriting businesses have actually been able to make back some of their losses by actually moving pricing significantly higher. This short-term capital is coming into our industry and taking away the ability of the industry to recover its profitability and to build its reserves and to rebuild its capital. And that's a great threat, and more of a threat than I think people really understand. And it's in great danger. The industry is in great danger of actually, I believe, diluting its franchise, and needs to be very careful over the next 2 or 3 years how it actually deals with this hot money. Of course, it's beneficial to earn the fee income that's associated with that, those new capital structures, but be very cautious of the dilution to the franchises that you've all worked so hard to build over many generations. Sorry, excuse me. I think the greatest threat in the near-term future to our global businesses, to the global specialty underwriting business, is actually the commoditization of our business that I have witnessed certainly over the last 20 years. You know, I've been around. I am one of the last dinosaurs. I'm pleased that I'm not sure if I have actually outlived, or not outlived, but survived Robert Hiscox, who's another one of the great dinosaurs, who I think the market should pay great tribute to. But I've been around for 42 years in the industry and seen wonderful change and fundamental change that has only strengthened our industry. But I've also been extremely concerned over the last 20 years about the way that the markets have actually tried to commoditize our specialty products. And I actually believe that it's impossible to do. It may be convenient, it may be very efficient, it may be beneficial to certain parties, but for the underwriting community, I can assure you it's our greatest threat. And why has it occurred over the last 30 years? Well, during the 80s, it was only really during the 80s that actually we saw the formation of global broking houses. And Marsh were the first to construct a global broking structure, and then quickly followed by Aon, and then followed by the rest of the broking community. But that in itself was really not something that could have brought about that commoditization, that surge towards it, because it happened to coincide with the explosion of technology that is reinventing itself now every 5 years. And so coupling the formation of global powerhouses as broking houses and aligning that with really fantastic technology and connectability that leads to global competition and real-time global competition. You know, our markets were just not prepared for that. And it took us until really the late 90s, in my view, for us to really begin to understand and grasp the need to actually change the fundamentals of our business. We could no longer safely sit in London. We could no longer safely sit in Bermuda and expect our distribution network to come to us. We really had to establish the hub and spoke type infrastructures that we now all manage globally. And those hub and spoke infrastructures were in addition to the traditional global carriers that have been around for many decades, albeit a very small number. So we actually played catch up over the last 20 years. But we also, because of the pressure that was coming from the broking community and the client community to be more local, it was also an urge, I believe, amongst our profession to ride the emerging market wave. And I really am not sure yet we can hold our heads up high and say that it's worked. And I'll tell you why in a minute. Because I really believe that if you look back over the last 30 years, the unit costs of our insurance products have reduced substantially. There's nothing wrong with that, because over a 30-year period we should be more efficient, we should be more competitive, we have better infrastructure, we have better people, we have better systems. But what's happened is the fact that as we've been more competitive and we've reduced unit costs, we've actually continued to operate the most Dickensian of operating structures of any financial services industry. You know, I remember standing up in the early 90s and calling for some sort of global clearinghouse. And I was in London in that period of time. And here we are nearly 25 years later, and we're still looking at local solutions as an industry. And yet the banking industry for decades have actually had global clearing solutions. Our industry is not so complicated that with the technology advances that have been made over the last 20 years, that we can't find some sort of global solution. So we can organize ourselves and properly deploy our resources to the end of the business where we actually can differentiate, which is the underwriting end of the business. The back end of the business should be something that is almost taken for granted, should be highly efficient, cost effective. And yet I see nobody in our industry standing up and trying to address the cost base of the underwriting businesses. And against the backdrop of an extremely competitive marketplace over the next 2 to 3 years, that is a great challenge for us all. And when I talked about the emerging markets, these new business developments have really not produced the volume of business yet that we need them to do to support the infrastructure that has actually been established. And people rather naively think that the emerging markets, because of the scale of the economies that Steve identified in his speech, that naturally there will be this enormous outflow of new business. Of course that's not. The buying habits of Asians are fundamentally different from the buying habits in the Western world. For many people in Asia, buying insurance, whether it's commercial insurance or personal insurance, is an unlucky thing. They are still, in 2013, much more likely to go down to Sha Tin and put it on the number 13 horse that's racing than actually invoke the gods. And I think that we have actually paid, as an industry, the price for the lethargy and the complacency in actually not addressing the infrastructure issues that we all battle with every day. Because if you look at the way our shareholders have put valuations on our underwriting businesses, you will see over the last, for those of you who are shareholders in your businesses, that over the last decade, the price to book values of our businesses have dropped by between 30 and 50%. And that's not going to go away soon. And we can't, as an industry, sit back and just hope that investor sentiment will change. We have to do something about it, which speaks directly to Steve's point about technology advancement. So who has benefited out of the last 20 years? Well, the clients have done, obviously, because their unit costs have actually decreased dramatically. In my younger days, insurance cost was a substantial budgetary item. I worked for a ship owner, a Chinese ship owner, between 1981 and the end of 1986. I knew exactly how relevant it was to the profitability of that ship owner. To so many of our specialty customers nowadays, it's really not a major budgetary item. And I challenge Steve, who has to go in front of his client base. I would love to be a fly on the wall, because when Steve's broking a piece of business to us and telling us that he's done rather well by actually increasing our pricing by 5% or 4% or 6%, I wonder what the other side of the equation is when he's standing before the client and saying, well, your exposure's gone up by 10%, and by the way, we've broadened the coverage, so on a risk-adjusted basis, you're doing pretty well. So let's not forget that. the other side of the equation is the fact that the brokers are being, he won't agree with this, are being very highly compensated by us for desperately needed distribution, which we have failed to actually progress. Mindful of the sort of technology that's available. And that is what's killing us through our cost base. And that distribution, the brokers' distribution, they have such a strong stranglehold on our industry because, quite frankly, we're still very fragmented. There's still far too many of us. We don't have surplus capital, in my view. What we do have is a very substantial surplus of underwriting operations, which is just not sustainable either in today's marketplace or for the next 3 to 5 years. And I think it will be a huge drag on earnings. So let me just talk about our clients. And forgive me for being broadly descriptive about a lot of this stuff, but it is global. One of the greatest concerns I've had is the fact that when I grew up, risk managers used to have board seats. And they were a critical part of a board's understanding of the business and regularly presented to boards of major companies, especially public companies. But over the last 10 years, they've been, in my view, completely subordinated to company CFOs, to the extent that it's my impression that very few of them actually present to boards. And I suggested to AMIC, I think, some years ago, that they should lobby the government, because we have to live in a risk environment where our regulators require us constantly to identify threats and to actually make sure that those threats that are identified are properly dealt with within our capital structures and our risk profiles. It seems to me incredible that our client base is actually largely ignored by global regulators in terms of the fact that the vast majority of them have captives. The vast majority of them are taking significant risk on their own balance sheets. The vast majority of them have a complete lack of transparency and disclosure about those risks. And I challenge anybody in this room to go back and look at a certain major oil company that only had 2 letters in its name and had a major event a few years ago, and to find more than 4 or 5 lines that described the complete self-insurance that they practiced for their major global business, to such an extent that that loss has destroyed something like 30 or 40% of the shareholder value. And it does seem to me that we need to be stronger in terms of our lobbying to try to get the people that we need. We need a much greater, and I think this applies to the brokers as well as underwriters, we have to get out in front of the clients, and we have to really try to get them to understand risk in the same way that we now understand risk and deal with risk. Because I really believe an awful lot of it is being swept under the carpet and deliberately ignored. And as a shareholder in many, many different industries, I feel very strongly that the lack of disclosure is very inappropriate. And one of the problems that we've had to deal with over the last 5 or 6 years since the recession is a lot of our client base has disappeared, either through mergers or acquisitions, or has actually just gone bust. And the economic growth, which I'm going to talk about fairly shortly, is going to be stunted for quite some time. But the reality is that, in my view, certainly within Fortune 1000 companies, there's a very strong question mark as to whether they are substantially underinsured. But I really believe we have to take the fight to them as opposed to sitting back and waiting for them to come to us. Because how else, if you look at the economic losses that came out of the Thai floods, as well as that energy loss. These were huge, and we need to be in front. It is completely inappropriate that out of that energy loss, that shareholder diminution of value, that only 3 or 4% of it actually was paid by the insurance and reinsurance community. You know, we may have been lucky and dodged that one, but on the other hand, it doesn't say very much for the strength of our industry that a company of that scale and size can actually think that it doesn't need our industry to protect its assets. Talking about brokers, and Steve's a very good friend of mine, so I know he'll forgive me. One of the things that, another great thread is the fact that it's undeniable that brokers over the last 15 years have found it easier to be, more convenient to be compensated by carriers than they are from their clients. And I think that's a fundamental mistake. It's inappropriate from a carrier point of view that that burden is pushed towards us. I think there's a fundamental conflict of interest when you're being paid by both sides of the equation. And it really comes about really through the broking activities that were practiced in the 80s and early 90s before much stronger management was introduced. And where essentially the broking marketplace were essentially giving away their brokerage because they know they could make it up from the carriers, either through volume placements or actually by the reinsurance that they were able to extract from the carriers. So coming back to the cost of the carriers doing business globally, I think that that burden is going to be is not going to be sustainable in the near term, and something needs to be done about it. Our shareholders will not sit back and allow our industry to continue to throw greater cost at a product when so much of that product is seeing significant margin reduction. And as I said, the way the capital markets are interacting now with the industry means that you cannot go out and obtain strong profitability, because moderate profitability is the name of the game from here on in. And another issue I've had with the brokers is the fact that by driving efficiency, and they're very good now, we've got some really first-class managers of broking houses nowadays, means reducing overheads and cutting staff. But importantly, it means cutting the global bench strength of expertise and experience. And you know, if you're a broker and you're faced with that, cutting your cloth accordingly, the only way you can really survive is in a funny way to drive the commoditization of the products that you're having to put into the marketplace, because it requires less specialization, it requires fewer people, and those fewer people are having to do a lot more work. And I don't want to encourage the broking community to believe that they can continue to bleed the underwriting community until a major transfusion is required, because there will be a significant change if that occurs. And let's move on to carriers. As I said earlier, my view very strongly that there isn't surplus capital in the industry. I actually believe that there are just too many underwriting carriers. Not only in London, everywhere I go around the world. And everybody's pretending to have the expertise and the modeling capability to be able to venture into pretty well most products, either through the insurance marketplace or the reinsurance marketplace. And that's plainly not the case. And that, again, in the near term is adding great strain to the industry. And we're lucky because we actually have not seen any latent liability issues emerging from the US. It's been the first decade, the first 10 years of 2000, have been the first decade in my history where we've not seen an asbestos, we've not seen a pollution crisis come through. But we can't rely on luck, quite frankly, for our good fortune. I've touched on how I believe our infrastructures are hugely inefficient and Dickensian. We really do need to, I hope all of the carriers in this room, if they were asked to set up a new company today, it would be very interesting to see how many of us would actually fully embrace the technology that is now available to have almost a virtual back office. There are outsourced companies now, highly efficient, that weren't there 11 years ago when I established Access. And what we need to do is to look at where our resources are best used. And quite frankly, our resources are best used at the front end where we have the intellectual capital, which is our underwriting expertise. And at the moment, we're being too diverted by the cost and the infrastructure that we're having to replicate around the world, which is just not capable of producing the profitability and to grow the revenue that we need to prosper in the future. I also believe, but when you get to my age, you can say this sort of thing, and everybody expects me to say it, but there is a lack of deep underwriting bench strength when I look around. And the underwriting bench strength, I mean at all levels. One of the great problems with the carriers, global carriers, is the fact that nothing wrong with having people from very strong, solid financial backgrounds, but very few of the senior management now in a lot of the global carriers have got any underwriting experience. And I'm not trying to protect my own profession, but I do believe that you need embedded both financial and underwriting experience, because nobody seems to be joining up the dots. It is not just a matter of sitting back and looking at financial statistics. You need to have a very clear understanding of the global marketplace, of the different products that are involved, the different pricing constraints that you're meeting, what are the threats and dangers. And I find it difficult to get a feel within the industry that we have today that expertise, that embedded expertise. And I think we lost a lot of it. There are some first-class managers, don't get me wrong, but I'm very concerned about the lack of bench strength, underwriting bench strength at the very highest levels of our industry. And then looking into when we look at this year and the next, to me, I would suggest the next 3 to 4 years. I think our industry, the carriers, are going to be under extreme pressure from an earnings point of view. The asset side of our balance sheet is yielding very little. Most of us are involved with short-dated investments. Those investments are now maturing at pretty well minimal investment rates, so that the asset side of the balance sheet is earning us nothing. And yet that was a major contributor to our balance sheets. It is not likely to change because central banks have signaled that unless something comes and sideswipes us, that interest rates are not going to change for the next 3 or 4 years. So what do we have to then as a carrier rely on? Underwriting margin. As I try to spend the last 20 minutes, which is far too long, saying that I don't believe the underwriting margin is there to carry the industry forward. Investors are not going to allow us to return 7, 8 or 9%, regardless of whether an interest rate is nothing, because we're in a risk business. And quite frankly, our history shows that earning risk-free returns has not been our greatest attribute. So with that, what I'd like to do is to throw it back to you, Mark.
Well, great. Please bring your hands together for John Charman. Thank you so much, John.